The energy sector, vastly outperforming their peers over the past year, beating their closest competitor out by 25% relative to the S&P 500. The energy sector is comprised of many companies engaged in the exploration and production, refining and marketing, and storage and transportation of oil, natural gas, coal, and other consumable fuels. Also included in the energy sector are companies which supply equipment, materials, and services to the energy producers. Although renewable energy companies are beginning to gain much more momentum, especially over the last 2 years, as they continue to change the competitive landscape of the energy and utilities sectors and have the benefits of many other elevating factors, the global industry classification standard has yet to add them to their structure, as there is not yet a consensus on how to reflect the changes. With that being said, other classifications consider there to be a renewable sub-industry of the energy sector. Today we're looking at the driving factors of the energy sector, which include consumption, production, and the prices of the underlying resources and other refined products. These price movements and recent changes in production of the specific commodities have an effect on how energy companies generate revenue, allowing us to predict which companies will succeed. Comparing the sub-industries of the energy sector as reported by FinViz, coal has returned the greatest profits compared to their peers, returning 100.48% relatively, followed by oil and gas drilling at 56.36%, then exploration and production, refining and marketing at 34.1%, oil and gas integrated, midstream, and equipment each had relative returns under 25%. It's no surprise that the oil and gas companies are the largest driver of the energy sector, so we'll take a look at them first. The U.S. Energy Information Association, or EIA, shows domestic crude oil production increasing as of late 2021 and continuing to do so through 2023, reaching pre-COVID levels once again. Similarly, the world crude oil production bounced back, however it did so much more quickly, already reaching pre-pandemic levels as growth begins to slow down. In regard to the importation of crude oil and liquid fuels such as petroleum, the US was on a large downtrend, but as of midway through 2021, importations have become more consistent, averaging roughly 3 million barrels per day. Why talk about production at all? Because supply and demand drive the price. In addition to the price of imported crude oil beginning to flatten out after a July 2022 local maximum was reached, domestic crude oil prices have also done so, as exemplified by West Texas Intermediate, WTI. This graph gives another incredibly useful piece of information, as the New York Mercantile Exchange, or NYMEX, shows a 95% confidence interval, which has a larger magnitude in the positive direction. Because crude oil is refined into gasoline, production and pricing of the natural resource do have an effect on gas production and retail gas prices. Here's the U.S. petroleum overview since 1950. Consumption in blue and exports in yellow have steadily increased over the 7-decade period. On the other hand, imports in red and green have been decreasing since 2005, a couple years before the U.S. ramped up production of crude oil by about double. As petroleum consumption continues to increase while imports are being reduced and production increases more quickly than exports do, it seems that we are becoming much less reliable on global oil producers over the past 20 years. Although this may be the case, domestic operations have not increased production enough as legislators shift their focus towards renewables, which we will discuss later. For this reason and many others, the U.S. gasoline prices have spiked dramatically over the last 3 years, reaching an average high of $5. You can also see here how the price of crude oil and gasoline mimic each other. Like this video if you want lower gas prices. Alright, now shifting from oil to gas. The EIA reports U.S. natural gas consumption is trending upward over the past 2 years. I know this graph looks a little wonky, but remember, natural gas is much more cyclical than gasoline, as it is used significantly more in the winter months to heat people's homes. The production side of things is something to be pleased about, as the EIA have estimated just below a 10% increase in natural gas production from 2020 to 2023. This is exemplified in their natural gas price expectations, as well as the short-term economic outlook expecting a decrease in price to occur. We've now looked at crude oil, gasoline, and natural gas. Another cyclical resource is electricity. We can see here electricity generation stays pretty consistent. However, the generation source has changed over time. Since 2012, non-hydro renewables have consistently increased, which we cannot say for any of their peers. Here are the residential electricity prices, which have been slowly increasing since 1980. In this industry, however, I believe you should pay more attention to the source of the electricity rather than the price. If you're looking for which sources of renewable resources generate the most electricity, National Geographic has a great tool for that, which I'll link in the description. These maps show globally that hydroelectric energy production beats out geothermal, solar, tidal, and wave energy, as well as wind energy. If you're looking for a renewable energy industry to get more familiar with, this might make the case that hydroelectricity is that specialty. I want you to remember though that things are now beginning to change dramatically in the energy sector, especially in regards to renewables. One of the largest reasons that hydroelectricity has such a large market share is because the technology has been around for the longest time and been optimized for the longest time. As other technology for other different renewable sources became more efficient, hydroelectric market share began to dwindle. If you have a focus on the renewable energy industry, keep an open mind concerning this technology. Knowing the underlying price drivers for industries within the energy sector, as well as the EIA 2023 price estimates, we can obtain a clearer picture for the future of companies within the energy sector. Looking at the top 10 holdings of the Energy Select Sector SPDR ETF, stock ticker XLE, which we discussed last week in my video on the sector rotation theory. Make sure you go check that out if you haven't already. I recommend you do that before continuing with the sector deep dives. ExxonMobil XOM and Chevron Corp CVX account for roughly 45% of the XLE ETF. A comparison of the two companies' relative returns over the past year compared to the Energy Select sector show that ExxonMobil have beat out their biggest competitor by about 14%. An increased global demand for gasoline, diesel, and jet fuel have resulted in margins for the refining industry to widen, setting apart ExxonMobil from their peers as they have the largest oil refining operations among the oil majors. Here are some other energy companies sorted by industry and graphed by their daily returns on August 19th. I'm going to link this in the description below too. You can pull some investment ideas off it, plus it's really just kind of fun to play around with. These tiny blue dots over there representing the thermal coal industry should be some companies to pay attention to, as the industry blew their competitors out of the water over the past year. As explained by Javier Blas in his article, Far From Dying, the coal industry is actually booming. Demand for coal is higher now than ever, despite efforts to switch to a cleaner, more renewable energy source. What goes hand in hand with demand? Price. Both thermal and metallurgical coal prices have shot up dramatically over the past 2 years after trending down since 2016. This was largely due to consistently increasing electricity generation worldwide. This chart does a great job of showing that in reality, we are still incredibly dependent on fossil thermal sources of electricity such as coal and natural gas. Furthermore, the International Energy Agency, IEA, predicts the total global consumption of coal will hit a record high this year, continuing to increase alongside power generation. Industrial coal uses in the steel and cement industries will help elevate this as well. If you like what you've heard about the thermal coal industry, throw me a like and subscribe. Then open up a new tab and pull up Arch Resources, stock ticker Arch. Adding them to our relative returns chart, comparing XOM, CVX, and now Arch in pink against the 1-year returns of XLE completely changes the perspective, and they aren't even considered overvalued by analysts yet. More than doubling their share price over the last year and adding roughly $40 since August 1st, Arch Resources is estimated to have a positive potential outlook in the short term and long term, and currently only have a PE ratio of just 3.15 and a price to sales ratio of 0.93. Their PE ratio is significantly lower than that of the coal mining industry, which averages out to 11.05. If we can get at least 25 likes on this video, I would love to do a stock analysis on Arch Resources. Let me know what you think in the comments below. Now, the data that we've looked at so far makes the energy sector appear to be as strong as an ox, or in this case, a bull. Remember, however, every sector has their Achilles heel, and the energy sector was the most volatile through the 2010s period. In addition to high volatility, the energy sector is very sensitive to political events, which have historically led to volatile oil prices. From 2020 to Q1 2022, the average oil price almost tripled, escaping reduced post-pandemic demand and transitioning to uncertainty about global supply due to Russia invading Ukraine. Furthermore, energy companies often have high capital expenditures as well as expenses for research and development and legal proceedings. During high inflationary periods, as the buying power of the dollar decreases, the level of cash available for capital expenditures decreases as well. Likewise, an environment with higher interest rates makes borrowing for research and development more costly. Although the energy sector is considered to be most volatile, there are many companies within it that can add some middle-of-the-road defensiveness to your portfolio, coupled along with growth opportunity because of the changing landscape within the industry. Check out my video on the sector rotation theory where you can see a comparison of the returns of the energy sector compared to all other sectors quarterly from just after the March 2020 crash till now. And don't forget to drop that like on the video if you want to see a stock analysis on Arch Resources. As always, I'm Patrick Zimmerman. Thank you for your time and have a nice day.